Professor Semes, have you brought the participants in?
Yes, we are open and I believe we are recording now.
Excellent, thank you. Well, Villanova University Law School graduate tax program has been providing educational opportunities for professionals to get MTs and LMs for over 40 years. But in addition to that student programming, we also like to provide educational opportunities to the broader tax community, such as this webinar. Professor Semes will have another webinar perhaps later this year, maybe some next semester. And for anyone who's an alum who's on right now, we have a CLE alumni event with Villanova Law School on the Inflation Reduction Act on October 20th, which we would encourage you all to attend for some in-person networking and some free CLE. Today's program is the importance of proactively managing transfer pricing risk. This is very timely for our program, the graduate tax program, as we've recently split out our international tax class into two classes, inbound and outbound transactions. And we hope to be bringing 3 to 4 additional international tax classes online in the next 12 to 18 months, including transfer pricing class. So I'll be taking copious notes to steal this good material for that class also. Today, we've got a great moderator, Professor Semes, who created this presentation. Professor Semes is a full-time professor here for the graduate tax program, where he focuses on our foundational classes for students and also SALT. He's a student favorite, not just because of his mastery in the classroom, but also because of the work and dedication he provides to the students outside of the classroom. He's also currently off counsel Baker Hostetler, and his previous accomplishments would probably take up this entire presentation. So I'll just highlight a few. He was a past partner of Blank Rome, a principal at E&Y and PwC, all in tax practice, past chief counsel of the Department of Revenue, and a proud JD alum of Villanova University. Professor Semes has brought together a great panel for us today. First is Michael Stratis, the principal at PwC, specializing in international tax matters, and also adjunct professor here in the grad tax program, where he teaches our survey class to the initial MT LM students as they first come into the program. Glowacki is also a principal at PwC, focusing on international tax matters and specifically transfer pricing. He's a Villanova MBA alum focused on international business, and he's been a frequent guest lecturer for us in the graduate tax program. And I'm not sure if Andrew Woodman has joined us yet, but we hope he will join us.
I am on now. Apologies for running a few minutes late.
Andrew Woodman is here with us now. He's the director at Sumitomo Mitsui Banking Corporation, an international bank headquartered in Japan with over $2 trillion in assets, where he focuses on international tax planning, policy, and transaction review. Previously, Andrew worked at a number of larger firms and Big Four accounting firms with a focus on international tax matters. So with that, Professor Semes, I pass it over to you to go over the agenda and start the program.
Thank you very much, Stephen. And I really want to thank our panelists for sharing their time and their insights with us, because without them, this would be all theory. And we want this to be not just theory, but practice. And speaking of that, what we're going to be doing today, I'll just go over the agenda. There's the contact information for our panelists, but we're going to start off with some theory and talk about the background and theory of transfer pricing in the United States. And because transfer pricing is a cross-border concept, we necessarily have to look beyond our US borders. And so we're going to look also at how the OECD perceives transfer pricing. So that's the theoretical part. Then we're going to migrate to the much more practical part. And again, I just can't thank our panelists enough, but they're going to talk to us about how the consultants, Brett and Mike, and in-house practitioners, Andrew, how they have differing views or maybe the same types of views, but they look at transfer pricing issues from slightly different perspectives. We also would like to take your questions throughout this webinar. So if you could put them in the chat box, we'll do what we can to address them. But then we'll also leave a little bit of time at the end for you to ask questions through the chat box. You're going to be on mute, so you're the only alternative or only way to ask the questions is through the chat box. So with that, I'm going to hand it over to Brett for the beginning of the theory and background on transfer pricing. Brett?
Thank you, Mike. Good afternoon, everybody. Thought I'd spend just a couple of minutes giving you a very high-level background and overview of what transfer pricing is, so that when Mike Stratis and Andrew and I begin to talk about some of the practicalities, you've got at least a little bit of a base. So what is transfer pricing? So it's anytime that we've got a company that is operating on two different sides of some type of border, where the opposite sides of those borders tax the profits of that corporation slightly differently. And the reason I'm using that specific language is because it could be an international border, it could be a state border, it could be within a state, actually. So anytime that we move a good or a service or an intangible across one of those borders, it's going to generate some level of profit, and that profit is subject to tax. So obviously the tax authorities are interested in getting as much profit into their jurisdiction as possible, such that they can collect the appropriate amount of tax. So the rules were essentially put into place, a number of years ago to really prevent tax avoidance. Because if you think about the premise here, to the extent I'm one corporation and I'm able to, for lack of a better word, manipulate some of my profits to get into more tax advantageous jurisdictions, that's obviously something that's in my best interest. So the rules are there to essentially prevent that type of abuse. And you might say, well, how do I determine what my level of profit in a particular jurisdiction needs to be? And the governing rule, both in the US and for most OECD countries, is the arm's length principle. And what the arm's length principle says is essentially that if I engage in any type of transaction, again, tangible goods, intangibles, or services, with a related party, it needs to be transacted at a price that is similar or equal to the same level of compensation that would be due if I were transacting with an unrelated party. So two third parties basically negotiating in good faith what something is worth is how we ought to be treating that for transfer pricing purposes.
And Brett, I'm sorry to interrupt you there, but being a state and local person, these rules apply at the state and local level, because just like we have transactions occurring across international borders, at the US level within the states and across state borders, we have transactions going across state borders. And so these same types of principles apply, but there is certainly less well-developed case law and less developed principles at the state and local level.
That's absolutely right. So once we get into kind of the world of TP and what Andrew and I are kind of dealing with on a regular basis, there are really three main types of work that we do. So one is compliance, the second would be more planning, and the third would be controversy related. So compliance is exactly what it sounds like. It's annual reporting, it's testing to ensure that the transactions between our related parties are being conducted at arm's length. It's proof to the tax authorities that what we're doing is applying or adhering to the local laws and regulations. Planning is I'd say some of the more fun things that we do. So there we're typically looking at potential tax inefficiencies to try to align the transfer pricing and profit allocation to get the best possible answer within the confines of the law. We can think about mergers and acquisitions. Anytime that a company grows or it shrinks, through a divestiture as well, there might be a realignment of the facts or value drivers within that company that dictate a different level of pricing and compensation. And then third, really just thinking about how companies evolve organically, right? Over time, a lot of companies have changed the way that they operate. If we think about what's happening today, most companies are becoming very digitized. They're thinking a lot about different value drivers and how they reach the market in a different way. That level of thinking and that level of strategy might be changing the way that that company has operated and what has driven kind of the overall profits for the company in the past, which again can dictate a different type of transfer pricing policy or mechanism to be put in place. And then the last area is controversy. So controversy really comes up in two different forms. So one can be, I'll call it defense. So that's when a particular taxpayer is picked up for audit by one of the taxing authorities, and we're trying to defend what the client did, to say that that the transactions that were actually carried out throughout the year did in fact meet the arm's length standard and no adjustment is warranted. The second is a bit more offensive. It's an area that we call advanced pricing agreements. So this is essentially where a taxpayer will go to a tax authority preemptively ahead of actually engaging in a transaction and saying, hey, this is what I plan to do. This is how I plan to operate. This is the level of compensation that I would like to put in place. And you essentially are agreeing with the tax authority that that is what is going to meet the arm's length standard ahead of time, and that prevents audits. So generally APAs are put in place for about a 3 to 5 year period, sometimes with a look back period as well. Like, if we could go on to the next slide. All right, so when we're doing a transfer pricing analysis, what we are really trying to determine, again, is the allocation of profit amongst the various entities that are engaging in this cross-border transaction. And what drives that profit allocation is functions, risks, and assets. And say generally the most important is the asset component. So there we're typically talking about intellectual property. And intellectual property can take many different forms. But generally, and that's a big caveat, is generally that kind of the funding and development and strategy around the development and ownership of intellectual property is what's going to attract the highest level of profits. There are certainly exceptions to that rule, but for the most part, I think that's a good starting point. So when we are beginning our first analysis of a client or a company, right, we want to really understand what each of the entities is doing, like what functions are they performing, and what is the intercompany transaction that is actually taking place. In order to do that, we start to categorize the types of transactions and the types of entities that are engaged in those transactions. That kind of helps with our analysis. So if we think about if there's a tangible good being sold across an international border, ultimately sold to a customer, right, we might be looking at a distribution type of transaction where we've got tangible goods moving back and forth. Similarly, we might have a contract manufacturing or tolling transaction, which would be treated differently from a TP perspective. And then finally, there are services, there, again, intellectual property. There's a whole slew of different types of categorizations of types of transactions that we can get into. But it's important to really understand, again, all of the functions that are taking place at each of the respective entities, because once we understand that, we are able to come up with a transfer pricing policy. And that policy is going to be, again, dictated on the functions, risks, and assets of each entity respectively. Typically, the entity that is more complex, so whether it's the ownership of intellectual property, or it's taking on more risks, or it's got more key decision makers, things of that nature are generally, again, going to attract higher levels of profit. Mike,
and Greg, maybe I can interrupt and ask a question here, and I'm just asking the question from my limited state and local knowledge, but it seems to me that intangible property is a lot easier to move across borders, and therefore that's where a lot of the planning opportunities arise. That's one side of the coin. The other side of the coin is, okay, like you were saying, you have to have good business reasons, business purpose for engaging in these types of transactions, and I would assume that the countries involved are very much in tune with these kinds of potential shenanigans, and therefore are paying attention to these kinds of cross-border transactions more. Is that correct?
So I wouldn't say moving intangibles is easy. I'd say moving intangibles is probably one of the more difficult areas that we deal with. But certainly the movement of IP is one of the biggest triggers for controversy. That's certainly what tax authorities are looking for, again, because it's typically going to attract the highest levels of profits. So when we move IP out of one jurisdiction into another, the tax authorities want to ensure that they're being adequately compensated for the movement of that IP.
Got it. Thank you.
Great. Back one. Yep. So once we've figured out kind of the functions, risks, and assets, and we really understand the intercompany transactions that are taking place, the next thing that we have to do is an evaluation of the various methods. So under 482 regulations, we've got 5 specified methods for tangible goods. We have 6 specified methods for services, and several for intangible property as well. Generally, they're all pretty similar with some nuances. The US does not have any hierarchy of methods, meaning that any of these methods is equally as correct as the next. However, they need to be selected based on what is called the best method rule, which is the next slide that we'll get into in a sec. But essentially, each method needs to be evaluated to determine which one's going to provide the most reliable assessment of the arm's length principle. The kind of utopia of the various methods is the comparable uncontrolled price method. This doesn't come into play too often, but essentially it is saying that I've got a transaction with a unrelated party that is near identical to the same transaction I have with a related party. So the best example that I can give for this one is I've got a candy bar, let's call it candy bar A, and I sell it for $1, to a customer or to a third party. Under the same exact circumstances, I've got candy bar A and I sell that to my related party who is consuming it in the same way, right? If I charge it $1 for the unrelated party, I need to charge $1 for the related party. That's, again, kind of the utopia scenario. It's hard to come by, but when it does appear, it is typically picked as our best method. The other methods, again, are all facts and circumstances specific. The resale price and the comparable profits method are both transactional methods. So again, typically looking for a similar type of transaction directly with a third party, and looking at gross margin or gross profit markup as an indicator about whether or not what we've done on a related party basis is consistent with those third party transactions.
I'm sorry to interrupt you again. We have a question, and the question is: so there's a licensing of IP element to transfer pricing. That's the question. Is there a licensing of IP element to transfer pricing?
Absolutely. So if we enter into a license, again, across an international border, that's subject to transfer pricing. Licenses can be determined in multiple different ways. One of the things that we do look at there is similar to CUP, but it's called the CUT, Comparable Uncontrolled Transaction. So that's where we would be looking at similar or close as a possible identical contracts for similar licensing of IP. That inherently sounds a little bit strange because intellectual property by its very definition is unique. So you're never going to find the exact same intellectual property to be able to compare. But we try to find things that are as close as identical as possible.
Okay, and maybe I'm skipping ahead a little bit here, but then when you're doing a transfer pricing analysis, do you look at whatever, and maybe more than one of these methods would be applicable? And so you get kind of a range of transfer pricing?
So the rules under 482 say that I need to pick a best method. So that is a singular method. That is going to be the method by which we do the primary analysis. Now, very often, especially when it comes to intellectual property, we'll pick another method as corroborating. and just try to make sure that we've got some level of overlap or that we can defend it in multiple ways. But the rules specifically say that we need to pick a singular method that is our best method. Now, when it comes to a range, Michael, that's an interesting concept. So a lot of these methods do typically come up with ranges. We very rarely, with the exception of the cup, come up with a very, a single point saying, I need to charge $1. A lot of these are going to be looking at, again, either transactions that exist between the taxpayer and a third party, or between two completely unrelated companies that we would essentially benchmark. And that will give us multiple data points from which to assess the transfer price. And we typically do come up with a range. In most cases, we use an interquartile range. It is not mandated by any of the rules that is what we use, but that's what most tax authorities across the world typically like to see.
Great. No, that's extremely helpful. Certainly helps me understand this a little bit better. So is it fair to say that we've now looked at the US side of it, and now we want to look at it from the OECD perspective, Brett?
Sure. Yeah.
Okay. And I think we've heard a lot, most of us.
Michael, one thing I just want to hop in here before we move off the US piece. A lot of transfer pricing goes around what the actual price is that we're going to be charged. But one thing you have to be cognizant of is also the documentation that you do to make sure that the terms themselves are also at arm's length, which is something that can be a bit more difficult, especially if you don't have a third party that you're doing the same deal with. That can be kind of a pitfall in our documentation requirement times.
Okay, and somebody asked a question about how do exchange rate fluctuations impact transfer pricing when you're moving intangibles from one country to another? And is it fair to say, gentlemen, we're going to get to that when we get into the more practical aspects of transfer pricing later on in the show?
We certainly can. I'm happy to answer that question now or later, whichever.
Go ahead.
So exchange rate fluctuations are important for transfer pricing purposes, regardless of what we're valuing, whether it's intellectual property, tangible goods, services, et cetera, right? By its very nature, for the most part, again, we're crossing international borders. So you are going to have a lot of currency changes. The key component here is comparability. So when we're assessing whether a transaction meets the arm's length standard, again, we have to take into account all those things that I talked about before, which are the functions, the risks, and the assets of the transaction. Typically, there's going to be a complex entity, which is going to be usually your IP owner and risk taker, and a more simple entity, one that doesn't take on a whole lot of risk and functionally is relatively simplistic. Oftentimes, if we set the transfer prices such that we are capping the profitability of a particular entity, that simple entity, all the residual profit is going to flow back to the more complex entity. And this gets to Andrew's point a little bit about terms, right? So if I'm entering into a contract and I'm going to say, I'm going to allow you to limit the total amount of profit that I can earn, right? That means I'm essentially, a very limited risk entity. So I should not be taking on foreign exchange risk if I have got no potential upside. If I've only got downside and no upside, nobody's going to enter into that transaction. So if I'm going to limit my upside, contractually, what I would do is say, well, foreign exchange risk typically is going to be borne by, the counterparty. Again, facts and circumstances based. That is not a rule that is hard and fast. There are arguments to be made on both sides. The one thing that you'll hear Andrew and Mike and myself say throughout this presentation is transfer pricing is extremely subjective. There are arguments that could be made to come up with lots and lots of positions. So there are no true hard and fast rules. If you think that A plus B equals C, such as in accounting, that's not always true in the transfer pricing world.
Okay, and we have actually another question on exchange rates for you, Brett. And aren't exchange rates on a contracted basis, meaning that there's a futures contract and it's an element that is negotiated?
Could be. It doesn't always have to be. I would say a lot of my clients, for example, do not enter into hedging type of transactions to ward that off. That said, I've got several clients that do. I think it all depends on the type of industry you're in, and the volume of transactions that are crossing borders, and whether or not you're in a particular jurisdiction where there's a lot of volatility. As an example, a lot of my clients that have operations in Argentina or Venezuela or Brazil typically do enter into some type of hedging type of transaction with respect to exchange rates. But a lot of them don't necessarily have it when they're dealing with European countries that are operating on the euro, for example.
Okay, great. So speaking of the euro and jurisdictions outside of the United States, can you give us some background on what's going on with respect to the OECD, recognizing that this is a very complicated and moving target here?
Sure. So I think the first and foremost thing to keep in mind is that the OECD is not a governing body. Right? It is a standalone organization that comes up with recommendations that OECD member countries need to actually formally adopt into their legislation. So just because the OECD comes out with an idea or a set of guidelines or rules does not necessarily mean that every country is going to enact them exactly as written. I'll talk very quickly just about Pillar 1, and then perhaps Mike Stratis can join in the conversation for Pillar 2. Pillar 1 is interesting. It had a lot of traction a little while ago, but it is starting to die down a bit. So Pillar 1 came about when the OECD was really looking about digitization of the various economies. And what they were realizing was that there are a lot of sales that are made on a global basis in jurisdictions where companies do not have a physical presence. And through the use of the internet and web pages and various other social media, companies are getting access to large customer bases, and the amount of tax that they're paying is not necessarily reflective in the OECD's view of the value that customer base is creating. So they came up with this Pillar 1 idea, which has a couple of different components to it. So if we could switch to the next slide real quick, Mike, this helps depict a little bit about what Pillar 1 is. But the most interesting piece is that they've broken out the allocation of profit to certain jurisdictions where a sale is made into 3 different components that they call Amount A, Amount B, Amount C. And Amount A is a new taxing rate. It gets away from the arm's length standard, which is, I think, the most interesting elements of this idea. And essentially, it says that to the extent that sales are made into various jurisdictions, a formula needs to be used to calculate what residual profit is attributable to, I'll call it marketing IP or sales IP. A portion of that then gets kind of allocated to each of the jurisdictions where those sales are made. And it creates a new nexus or a new taxing rate for tax authorities where one may not have existed in the past. Amount B is taking routine functions. So let's just use distribution as the easiest thing since we're talking about sales. It's saying, if I'm a pharmaceutical distributor, you're automatically going to get a 5% return on sales, and I'm making that number up. Versus if you are, a commodity widgets, distributor, you're only going to get a 2% return on sales or something like that. So again, it's somewhat getting away from the arm's length standard by prescribing the amount of profit that is going to go to a particular jurisdiction. And then amount C continues to follow the arm's length standard and says, let's look at the additional activities that are taking place in market, and we'll allocate profit based on the typical transfer pricing methodologies. Pillar 1, as I said, it is kind of lost a bit of traction, and right now I believe the threshold is it's only going to be applicable to companies that are earning $20 billion in global revenues or more. So again, a pretty high threshold. It cuts off quite a number of companies. So it's really looking at kind of the behemoths that are selling on a truly global basis. So that's a quick overview of Pillar 1. Perhaps Mike Stratis could jump in and just give a quick overview of Pillar 2.
Yeah, happy to, Brett. And just want to underline one point that Brett made about sort of Pillar 1 and the OECD initiatives, this so-called BEPS. That's an acronym for base erosion and profit shifting. So about 10 years ago, the OECD had started this initiative to sort of bring antiquated tax rules up to the current state of companies. Companies are not just brick and mortar, selling widgets to people in countries. They're much more complex. Most companies have elements of digital or technology, and the tax rules really weren't there to sort of capture that. And so this Pillar 1 is one initiative that specifically addresses some perceived issues with transfer pricing. Pillar 2, in my mind, sort of serves as a backstop. It's sort of a global minimum tax, if you will, where the countries agree that every dollar of income or profit ought to be taxed at a minimum at 15%. And the way that it does this is sort of through two methods. There's what's called an income inclusion rule, which effectively means that if you're a parent in a group, a multinational group, that jurisdiction has the right to effectively top up the earnings of their affiliates to 15%. The second mechanism is where you don't have a parent that has this income inclusion regime, would be this so-called undertax payment rule. And effectively what that does is it allows other affiliated entities or jurisdictions to levy a tax to get up to that 15% on group earnings. So this is currently in development. It's not law yet. There's certain countries that are sort of first movers. The UK is one that ought to come out with rules, finalized rules soon. But the general gist of it is that they're trying to de-emphasize or de-incentivize moving portable profit into low tax jurisdictions.
Okay, so maybe we can pivot here a little bit. And as we go from the theoretical, and thank you, Brett and Mike, so much for that very, very helpful foundation that you laid, but move from the theoretical to the practical, and staying a little bit on the theoretical side here. I have a slide here that says, what should a tax system be? And I think economists and tax professionals, tax practitioners agree it should be simple, efficient, and equitable. But then as we get into the more practical side, we say, well, isn't there a political dimension, and isn't there a practical side? And now I'd like to turn to Andrew, who's an in-house practitioner and deals with this kind of thing almost every day, if not every day, and go back to the theory that Brett set forth that, transfer pricing is based around this arm's length concept. It sounds pretty simple and straightforward in theory, but Andrew, are there different transfer pricing rules around the country or around the world, or are the principles aligned? And if they aren't, what sorts of nuances do you have to navigate?
Well, Michael, and to go back to your SALT point earlier, it gets even down to the granularity of, are you a company that operates in separate return states? And now your US domestic transfer pricing, which if you're all part of one federal consolidated group doesn't exist, you now may be in a situation where a separate company, a separate return state is looking at your TP at that level with no rules whatsoever. And, when we look at 42 and the regime under 42 case law regulations, it's very robust, and yet oftentimes, and Brett and Michael will agree with this, there's still no conclusion based off all the case law and all the regs. So you end up into a position where it's a lot of sausage making. And a couple things go into that from, and I can give the in-house perspective because I don't think you're allowed to say this as public practitioners, but sometimes you have to make the assessment of whether or not this is even something that you're going to assess at a transfer pricing level. So if you have, a $5,000 expense that's going cross-border, are you going to take the time, go do the transfer pricing, or do you just take whatever looks reasonable? And, as you get through the complexity, both the US and the OECD side, really what you run into is marrying the two, because you're up against two very different regimes at the end of the day. And, the last thing here, politics, it plays into it because both countries ostensibly, if you're increasing your allocation to one country, it's decreasing it from another country. And then depending on what you're doing, to the point earlier about advanced pricing agreements, one of the great benefits of an APA is that you don't have to worry about a bad audit outcome in one country and then another country saying, oh, we're not going to give you a refund. And, while there's competent authorities in place who can manage these types of conflicts, it's very rare that you're going to get something that has enough meat on the bone to go through that expense and that rigmarole. So I think one of the hardest things to navigate from a practical perspective is that for most of these, aside if you have, two US affiliates, you're in one law jurisdiction, you're dealing with two separate countries with very different laws. In some instances, I mean, you take, Brazil came up earlier. Brazil has a safe harbor for some transactions, but it's like 15% markup, which is, maybe right, maybe wrong. So I think that's really where the rubber meets the road, is you're dealing with a lot of different rules that you need to get one transaction to fit into two different buckets at the same time.
And you have one view, and each of the respective taxing jurisdictions may have a different view, right?
Exactly. We have the correct view and they have the incorrect view. Apart from that, it's always the fear, the transfer pricing audit, because, and as was explained, by looking at what the rules are, there's no 100% perfect analogous transaction apart from when it's, for instance, we have a broker dealer as part of our group. And so if they're doing broker dealer activities for our bank, they also do them for third party customers. So we have, that's like the gold standard of transfer pricing. But when we look at things like IP, which are, much bigger dollar numbers, it's very infrequent that you'll be doing an IP deal with a third party you would do with a related party, as Brett said, by the nature of IP.
Yeah, and a couple of points on that, Andrew. One is that you raised, you have to look at transfer pricing across national borders. You also have to look at it across state borders. And I've seen, and I think you and I maybe have talked about this a little bit, but what do you do when a particular state, and I'm thinking maybe of California, Utah, Massachusetts, New York, when a particular state may not respect your transfer pricing study that the IRS has approved?
Unfortunately, there's no good answer to that. You try to bludgeon them with, listen, if we have to go to court, this is blessed by 482, and and the state has no rules on it. So if part of, that, like your point on equitable, part of it is supposed to be equitable to like situated taxpayers, and unfortunately, especially at the state level, and Mike, I know why you keep going back to SALT, I get it, but one of the reasons that it gets very difficult at the state level is there's very little case law out there, so you don't know how similarly situated taxpayers have been treated in the past.
Right.
And it's something that states are sniffing around more on. New Jersey now has an entire initiative dedicated to transfer pricing. And, what is it, one page they gave on guidance on how they're going to do it? So,
right.
I think that's at the state level, it gets difficult. And, it used to not matter as much, you get 7-8% state tax rates. No one used to care as much when the federal rate was 35%. Now it's only 21%. You've gone from 11% to 30% of your total state tax or total tax exposure. It becomes a lot more material. And unfortunately, the best that you can do is, and this again on the practical side, when you have a transaction where you have no comparables, what you'll do, you go to one of the big four, and they'll do a benchmarking study that was mentioned earlier. And you hope that waving that around will be enough that the state wouldn't try to overcome it. But, we've seen it at the federal level and we've seen it at the international level. If they think there's any meat there, or they're just going for a settlement, having a studies, it helps. But there's no perfect salve for this when dealing with government agencies.
Yep, and I think that ties into something that Mike Stratis said earlier, and he talked about kind of like the tax life cycle. He talked about planning and compliance and controversy. And Mike, when you're advising clients, how do you weave those three components and maybe a fourth, financial statements? How do you weave those together and take into the respective differences in perspectives, from planning, compliance, controversy, financial statement perspectives?
Yeah, I think a couple of thoughts. I think I like how you say life cycle, because they're all interconnected and they all depend on one another. And where I tend to start with clients is with the business, the facts. What are the facts? What are they telling us? What's the initiative that's going on? What is the new whiz bang IP you're developing, or the new transaction flow? You start there. That's when you sort of enter into the planning phase in my mind. And the planning phase is really just telling a client, look, you're going to do your business the way you're going to do your business, but here are different alternatives if you tweak certain things one way or another, where you could get to a better or worse answer from a tax perspective. Then once you have your planning set up, then you get into your compliance. All the planning in the world doesn't help you if you don't do the compliance right, if you're reporting the wrong numbers, right? and you have your transfer pricing reports, et cetera, which I've always, I joke with Brett, it's more of an art than a science in putting those things together. And to Andrew's point before, having proper intercompany agreements and all the sort of crossing T's and dotting I's is part of that compliance process. And if you do those first two steps right, your controversy step ought to be a heck of a lot easier, or non-existent, hopefully, right? And the controversy then would challenge those first two pillars. And I think that, in my mind, that's the life cycle. And I think you have to take a holistic view of your organization to be able to have a sustainable and compliant structure.
And Mike, you're completely right on the, it informing the controversy, where you do it right on the front end, getting your business folks in line. Because a lot of this, we're all tax professionals, but at the end of the day, a lot of transfer pricing is driven by what the business people are telling you they're going to do, and then distilling that down. And if you get that part right, you get the documentation right, it makes the controversy a lot easier for you, because you have something that your IRS or whatever taxing authority they have to overcome that you already have the study, you did it contemporaneously, prove why this isn't the best method. And, when I was in private practice, I saw the other side of, when you have no documentation, it's the best method is whatever the IRS has decided is the best method. And it's very difficult to overcome that. So, Mike, you're dead on that. If you do the first two steps right, it makes the rest of it a lot easier.
It's like being a good Boy Scout, right? Always being prepared, doing your homework. So, Brett, I think I've heard you say that the OECD has been putting a lot of focus on an acronym that we call Dempi: development, enhancement, maintenance, protection, and exploitation of intangibles. What is Dempi, and how does that apply to transfer pricing?
Sure. So when the transfer pricing rules first came about and really kind of got some traction back in the 90s, I would say that there was a concept of economic ownership of intellectual property, and that typically followed who was paying for it, right? So it didn't have to be a direct payment. You could have an affiliate, that is paying for R&D, on a contract basis. If they're being reimbursed on a cost plus basis, whoever ultimately paid for that kind of owns the intellectual property that was developed through that research activity. The Dempi analysis really is, or contingent, I guess, is the OECD's perspective that it shouldn't just be who is funding that type of activity, but really it's about significant people functions. So you need to have the right people in the right place to be able to claim that intellectual property is actually owned and supported in a particular jurisdiction. We often refer to that as substance. So if you think about, just moving a piece of IP, in the old days into, a Cayman company or Bermuda or something like that, where there were no people there at all, right? The way that the old school of thought was, well, that's where the IP is, that's where the profits ought to be. That is no longer the case, right? There needs to be actual people that are making those key decisions, that are taking on the risks, that are coming up with the strategy about how the intellectual property is actually going to come to fruition and how it's going to be utilized. So, each of those components of the DEMPE, right, are what people are actually carrying out each of those functions and where are they located. And to the extent that they are disparate and not all in a single location, that might tell you have components of IP in various locations, not necessarily centralized in that one jurisdiction where you really want them. So it's really, I'd say it's an OECD concept. The US is starting to kind of get on board with that. So they're starting to look at that a bit more. But certainly the OECD countries are very focused on significant people functions and where those people are located.
And Brett, I would just add, my own view is that, some of those rules that came out of BEPS and the OECD reports are really moving away from the arm's length standard. I mean, you can look in third-party transactions, you can own intellectual property without having those types of significant people functions in the real world, right? And so we see a lot of these rules coming out, which are effectively trying to shut down perceived abuses, but are really moving away from probably one of the main points of transfer pricing, or one of the fundamental aspects of it.
Yeah, Mike, I think you're absolutely right. And I noticed that there were a couple of students of mine registered, and I hope that they realize that the same concepts that the OECD is dealing with Pillar 1 and Pillar 2 are the same types of issues that the states, the Multi-State Tax Commission and the states individually have been going through and dealing with for the last 3 or 4 decades. And by the way, the OECD, I think, is an analog to the Multi-State Tax Commission, to the MTC. But Mike, maybe if I could go back to you. You talked before about planning. How does transfer pricing interplay with traditional international tax planning?
Yeah, absolutely. Where to start? So, I mean, I always start with the business. And as I said before, the business will do what it will do. And I think our job as tax practitioners are to help them understand the consequences of that. And so sometimes it can be a matter of quantum, meaning how much do I need to sell inter-party? And that's where traditional transfer pricing comes into play and tells you that you need to have some sort of arm's length methodology for how you're buying and selling or interacting between related parties. And obviously that sets up a dynamic where one would be incentivized to put portable profit in a lower tax jurisdiction. So if you think about the OECD like minimum tax now of 15%. Well, most jurisdictions tax at around 25% or more, right? So that's a 10% arbitrage on $1 million. That's $100,000. That's a very real large cost to a company that they may want to think about. it's not just about where that profit is taxed. It's also a question about where it's not being taxed. Andrew made this good point that you have to contend about two different jurisdictions in this transfer pricing conversation. And if you've moved $1 million from one jurisdiction to another, the jurisdiction that's giving up that amount may have consequences. So for example, they might not want to permit a deduction for that $1 million. And all of a sudden you have a disallowed deduction at a 25% rate. You may have, depending on the characterization of that transaction, I was using the example of product sales, but let's think about a situation where you have to pay a royalty. Somebody brought up licensing. Royalties may be subject to withholding tax. So maybe you characterize a transaction not as a royalty, but something else that's not subject to tax. You can characterize it as a services payment. There's a bunch of work that goes into thinking about how you characterize certain intercompany transactions where you might not even have a transaction to begin with, but you have to move the profit according to sort of a 482 or a transfer pricing principle. There's also the dynamic that I always work with about taxable presence. So there's a lot of cases out there and controversy around, this modern day concept of I can sell billions of dollars into a jurisdiction with having no taxable presence and therefore don't owe them any money. Well, the question is, what is a taxable presence? We use treaties right now that have concepts like permanent establishment or U.S. trade or business that can tell you what that is. It's a part that Brett and I work on quite a bit because I'll say, yeah, you have a taxable presence. And then Brett comes in and says, and this is how much you're going to pay under the attribution article or transfer pricing. I think there's also, you have these transfer pricing rules per se, but you have a lot of other rules that, jurisdictions have put into place. The US has these rules, we call them CFC rules or anti-deferral rules, which combat perceived abuse with related party transactions and put certain requirements on them. Some people on this call might be familiar with substantial contribution, showing that if you put profit in a related party transaction into a certain jurisdiction that's selling outside of the country of its incorporation, you have to show some sort of contribution to the manufacturing. So these are all the other different tidbits that get stacked on the simple concept of trying to properly price intercompany transactions. And one final point that I always bring up that people miss all the time with these types of arrangements or structures is once you put profit in a jurisdiction, the question is, how do I get it out in redeployment? Do I want to have it all in a jurisdiction where I really can't access that cash and it just accumulates? And the only way I can get it out is through, paying dividends that might attract a substantial withholding tax. Again, it comes back to my original point, which is you have to really understand your organization's facts and the business. Where do they have cash needs? Where do they need to put cash? What do their operations look like? Does it really make sense to move a bunch of the business to a low tax jurisdiction when you're going to be paying those people, double what you would pay them in a higher tax jurisdiction? It's that holistic approach, which I think really helps with doing sustainable tax planning, I would call it.
No, I like that, Mike. Sustainable.
Mike, the one thing I would layer onto that as well is, the new push towards more anti-hybrid rules at different country levels, going after intercompany transactions that are either, deductible but not taxable, or, if they're characterized in different ways in different jurisdictions. I mean, we see it a lot with Australia. They're very aggressive in pursuing their anti-hybrid rules. And, to what you were saying earlier about compliance, we have a yearly compliance issue in Australia because of these hybrid rules. So it's something, again, to think about. What else will you have to do apart from just the jurisdictions you're in?
That's right, Andrew. And this is another point I'd like to emphasize is, maybe 20 years ago, the game was trying to pay as little tax as possible. I think now it's really ensuring that you're not double and triple taxed on the same dollar of income. I mean, I see fact patterns all the time. Andrew, I'm sure you've dealt with them at your company, where, a single dollar of income, because the business wants to do what it wants to do, might, be taxed up to 75% on that dollar. And so it's really trying to understand all these different interrelated rules, deductibility rules, as you said, Andrew, to just ensure that you've sort of maximized the amount that is not being taxed.
And you're absolutely right. It's definitely moved away from, partially because it's become much harder to not have taxable income be taxed, but also, there's a push through the ESG movements to be good corporate citizens and to, if you're going to pay tax, pay it at a reasonable rate rather than gaming the system. And, that factor, I know my bank is a very big proponent of that now. And so it's something that also factors in terms of how aggressive you can be, versus, you get to a place that no one's happy, but no one's unhappy.
Yeah, I mean, and I just think from a political perspective, if a jurisdiction, whether it's a state or a country, chooses to tax at a lower rate or chooses not to tax a certain type of income, isn't that their free market right? And so why should then another jurisdiction, just because one jurisdiction has made that choice, why should another jurisdiction be able to pick it up on the backside?
Well, then you run into the other side of that, when we're looking at the cases in Europe right now of what constitutes state aid or not. And I think that's an interesting overlay because, that's kind of what they were going to bludgeon Ireland with for years, was that their low tax rate was state aid. So right. it's one more layer onto all of this.
Yeah, so Andrew, we've spent a lot of time talking about intangibles throughout the last hour or so. And Mike and Brett are constrained from talking about cases. Do you have any comments, high-level comments about cases and cost sharing and how that all relates to intangibles and some of the current things that we're seeing?
Yeah, I mean, so you had the cost sharing arrangement case that came out recently, and we'll go nameless and just say CSA case. But it's something that I'd want to mention earlier too, which is, part of this also, when we talk about transfer pricing, everyone's always talking about where we're putting profits, but you also have to look at where you're putting expenses. And in a lot of instances, those expenses are worth as much as the dollars that you're moving around. And it's something that when you're a foreign branch of a company, or a domestic branch of a foreign company rather, your head office expense is a huge expense. And these are the kind of things, like when we look at the cost sharing arrangement, you're looking at where you're putting income when it's successful, but on the front end, you're looking at where you're putting expense, amortization, and the countries don't like them because they inherently think they're unfair, but that's always going to be the case, right? There's never going to be a time where the state or the federal government is going to say, okay, great, IRS, everyone take the weekend off. We're happy with all of our taxpayers and what they're doing. And fortunately for everyone on this call, that's not the case. Otherwise, I think our careers might be a lot shorter than we otherwise intend. But I think what we're seeing, you have the cost sharing arrangement case, which was a big one, and now we're starting to see this interplay of what Europe's doing at the CGEU level, as well as and how it interacts with the US. And we saw it recently. It's not as much transfer pricing, but we saw it the French digital tax, where that got put on hold because of political winds. But the political winds overall are blowing towards taxing companies more in the aggregate. But I think some of the cases that have come out, where there was Coca-Cola was a good example in what they were doing in China, which is something we haven't touched on yet, but you need to update your transfer pricing studies. I think that was an APA they had relied on that was old, but their facts had dramatically changed. And so the standard, at least in our market, is 3 years you update your transfer pricing study. But it's definitely a pitfall taxpayers get into of not updating in time, and having bad facts or facts that don't even match. I mean, we've had it happens at every company and every taxpayer. I'm sure Brett and Mike have seen this as well. It's, hey, here's our transfer pricing study. We did it in 1993. And so it's, I think that's, Coca-Cola was a good example of that. You need to stay on top of your facts and make sure the transaction you're doing, if it's repetitive or over a number of years, that each year the transfer pricing is reflective of how it should be.
Yeah, and no, I think that's great, Andrew. And then, talking about things changing, the pandemic certainly changed a lot of things, both from a tax perspective, from a business perspective. Brett, what, if any, impact did the pandemic have on global transfer pricing issues?
Yeah, the pandemic was interesting, to say the least, from a transfer pricing perspective. A whole slew of different things occurred. So one of the methodologies that I had discussed earlier was the comparable profits method, which is where we go out and we benchmark similar types of companies for very routine functions. So think contract manufacturing, tolling, or limited risk distribution type of activities. And we typically target, a small level of profit that is both capped, but also there's a floor typically. So meaning that those entities typically would not, incur losses in the normal course of business. The pandemic threw that for a loop, because even when we're looking at some of their comparables that are normally very, sustainably profitable, took huge losses in the 2020 year. So we had to go through each of our client situations and assess what comparables we were using or what transactional methods were being applied, and either try to make adjustments for the 1 year anomaly. We could do that through looking at multiple year averaging. We could look at it from trying to understand the percentage of dip in sales or added expense, that was incurred to try to keep businesses afloat. There's a whole slew of different techniques that needed to be used, but I think what it showed us was nothing is absolutely predictable. So even though our clients were doing everything they could and operating maybe as they have been for years, our typical analyses were showing very different results because of the pandemic. So having to adjust for that, was something that we spent a lot of time on.
And Brett, I'd throw out there too, traditionally transfer pricing has looked at functions, assets, and risks as to where, profit belongs, right? And one thing the pandemic did for me, at least, was show that risk is a very real economic attribute. Meaning we saw clients that might have an entity that owns all the IP and all the entrepreneurial profit. Guess what? They earned losses because the IP didn't pan out, or they had supply chain issues, et cetera. But it just underlines that point that risk is a very real thing and ought to have some credence when transfer pricing determinations are made.
So Mike, speaking of risk and the uncertainty around Pillar 2, what do you think the future of transfer pricing is, and what kinds of risks are there, and how can people turn those risks into opportunities, take advantage of them?
Yeah, I mean, when I used my example before about 15% being the lowest rate, I did that intentionally because I wanted to show a lot of people panic that are in the transfer pricing world and say, oh, these rules are going to make our jobs redundant. And I say, no, they're not going to make them redundant. They're going to make them only more important. First of all, there's still a huge arbitrage between a 15% rate, a 25, 30% rate. Second, as I said before, a lot of the way that these rules interact with each other result in double taxation or even triple taxation. So to reduce some of those costs for an organization is important. I think also, as we think about sort of risks and managing risks, Inflation Reduction Act gave about $80 billion to the IRS to hire another 87,000 personnel. We're going to see controversy like we haven't before, particularly in the US, but I'm sure globally as well as part of some of these initiatives. And, it's going to be important for companies, to Andrew's original point, to do, have thorough compliance, practical planning, and controversy awareness going forward. And then finally, one other point that I would make about sort of the practice of transfer pricing is that companies and the way we do business is only becoming more complex. As I was saying before, even mom and pop companies now have digital supply chains or use apps or have online portals. Nearly every one of the clients that I work on have some layer of digital transformation going on. and their companies are only becoming more and more complex. And as that happens, the tax world catches up with that, and creates more rules make the tax impacts all that more complicated. And so I think companies need to stay aware of their business, understand how the rules are evolving globally in all the different countries in which they operate. Now where you have these, like the OECD with these blanket sort of initiatives and how they would interact to mitigate, again, double and triple taxation and to create sort of an efficient business model for their companies.
No, I think that's great. And one of the things, and I apologize to my students for saying this again. No, I don't apologize, because I think it's so important in the international arena and in the state and local arena. How do courts, how do taxpayers, how do tax practitioners apply old laws to new ways of doing businesses, new ways of doing business? The businesses are just evolving at such a rapid pace. And I think it's only getting more rapid and more complex, as you say, Mike. And it's just impossible for the, for the courts and revenue departments to keep up with it. And therefore, it necessarily creates a lot of gray and uncertainty.
And Mike, I would say as a sales point for future practitioners, like this is such fun stuff to work with, right? Like you learn about a business that's doing X, Y, or Z, and you're like, wow, that's interesting. You're like, I have no idea how, this tax rule is going to impact that. What makes our job really, really fun. And yes, I said fun in a tax webinar.
And Mike, to what you're saying earlier, we've kind of focused on, these bilateral deals between two countries. There's no limit on the number of countries that are going to be involved in one deal. We just did a deal where we had 5 different entities from different countries lending into a 6th, and then 2 other entities doing hedges on the back end. And it's like Mike's saying, I'm going to agree, because it is fun. We wouldn't be on this panel if we didn't all enjoy what we do every day. But it's only getting more interesting, because while companies aren't looking to pay zero, they're not looking to overpay. And really, that's kind of the sweet spot that you get into with transfer pricing. But it's also, if you're looking for heady technical work, I mean, transfer pricing is still a lot about the rules, a lot about the case law, and then seeing, what the finish line is of what exists, and then how much further you have to go to what you're working on. And that's really, if the technical issue is really fun, but I'm sure Mike and Brett will agree, it's really when you get past what exists out there and to figure out the real outcome, that's really where it gets very interesting.
Imagination and innovation and creativity applied to very heady and technical topics. I think it's great. Yeah, I mean, I just see so many parallels, and I don't, want to, reiterate too much about state and local and how these principles are the same. But, when I see the arm's length, the fair, equitable, words that lawyers just love, I see gray, I see uncertainty, but then I say, okay, how can we turn that uncertainty into opportunity? And I think that that's what you guys have done a great job expressing tonight. And I'd say that, there is a lot of gray out there. And then a tax technical word, I think that the transfer pricing stuff can be a little squishy at times. So with that, maybe I can ask each of our panelists, and thank you again, before I take it to have them do maybe a 30-second wrap up of their key takeaways from today, and then we can hand it over to Steve to take us out. So Andrew, why don't we start with you?
Sure. I think the biggest thing, and I'm going to probably steal Mike's, but it really is knowing the underlying facts of what you're doing. You need to take what's going on every jurisdiction, but it's also asking the second question of, okay, we're doing this from X to Y. Well, is Z involved? And, do you have a branch? So now you have another country involved. Is there a CFC regime you got to worry about? So it's really getting all the facts, all the relevant information down at the outset to make sure whatever your, transfer pricing methodology that you're going to use makes sense holistically across all the different, iterations and entities that you may have.
Thank you. And thank you again, Andrew, for joining us and sharing your wonderful insight. Brett.
Again, transfer pricing, all about the facts, as Andrew was saying, but it follows the business. So I think one of the things that gets left behind is most companies have big departments that are thinking about restructuring and expansion and divestitures and whatnot. And tax is often thought as an afterthought. Everything that happens operationally has some component of tax related to it. So getting involved in the business decisions and business operations from a transfer pricing perspective is imperative.
Thank you. And thanks again, Brett, for being a guest lecturer in the grad tax program. And thanks for participating today. Mike.
So Andrew stole my thunder with saying know your business, but I'll add a different one to it. Know the rules. And when I say the rules, it doesn't just mean understanding Section 482 or the arm's length standard, but understand all the other rules that come into play. And they could be different variations in different jurisdictions. They could be different types of rules. Understand what indirect taxes mean and how they could create an issue if you have an intercompany transaction. Understand all these different sort of components. You don't necessarily need to be deep in every single one, but I think the best professionals in our industry have a broad sort of footing and understand how these rules interplay with one another. And it's a really big asset to the company that you work for, or if you're a consultant, to your clients.
Well, thanks again, gentlemen. I really appreciate you sharing your time, your very valuable insights. And I got to tell you, I'm thinking about moving out of state and local tax into transfer pricing now after this.
Michael, come in-house. You can do both at the same day.
There you go. There you go. Thanks again. And Stephen, do you want to take us out?
Yeah, I would just reiterate the thanks to Michael, Brett, and Andrew for the presentation today. Super helpful. I suspect many of the people on the call already have an interest in this area, but I'm sure every day they're working on deals that involve significant dollar amounts, immense complexity. It's a really interesting area, but I think it was Andrew who also said, mom and pop now are going to start having these international issues more and more. And this is really going to branch out and start impacting just about everyone in the business world. So really informative, great stuff. Thank you everyone for your participation. Michael, thank you for putting this all together. And just one last plug, if you're a VLS alum or grad tax alum or in the program now, October 20th, we'll have another CLE presentation on the Inflation Reduction Act. It'll be live here in person and also simulcast. We hope that you'll all join us for that too, and hopefully perhaps even get to see us in person. So thank you all again.